Okay, hello everyone. Welcome to Invest Wisely workshop. First, allow me to introduce myself. My name is Hind Al-Assaf, and on behalf of the Saudi Group or Saudi Exchange, we welcome you to this workshop. I would like to welcome our colleague, Mark Taylor. Mark is a professional on derivatives and options in specific, and he will be presenting our workshop today. The workshop is part of Invest Wisely program, which consists of 4 stages: learn, engage, practice, and compete. This workshop counts as the second workshop of the recent program that we announced, which is Single Stock Options Awareness Program. We still have 4 more workshops to conduct, so please make sure you follow us on X, LinkedIn, to know more on the upcoming workshops. In terms of the workshop agenda, the workshop will take an hour, and then we will leave a room for a Q&A at the end. Please make sure to raise your hand and address your questions in the chat section. We will be able to address them at the end of the workshop. With that, I would hand it over to Mark to start. Mark, you can go ahead.
Good evening, everyone. Thank you very much for that. Yes, this is session 2 of our 6-part course on single stock options. So for those of you who joined us on Monday, we're going to continue where we left off on Monday. If you didn't join on Monday, you're probably in a reasonable position to pick up from where we start today. Monday was dealing with the option basics, so the very beginner stage of learning about options. Today, the idea is we take it to the next level up, and we start to talk about how the practicalities of trading options, how we might combine 2 options or more than 2 options together to create a slightly more sophisticated view on the market. As has just been mentioned, if you've got any questions, just like in session 1, please feel free to drop them on the Zoom chat. We'll either deal with all of the questions at the end, or we'll try to deal with them as they come up if it's appropriate. So the session should last probably with me talking about 60 minutes or so, maybe an hour and 10 minutes. So that should give us at least 20 to 30 minutes at the end for any questions that people have. Good. Okay. So hopefully on your screen, you can see my content, the title slide in front of you, probably with me up in the top left. Welcome if you're watching on YouTube or Twitter. Right. So session 2. Let's have a look what it's all about. Well, firstly, just to remind ourselves, these are the topics we're going to go through. And what I said at the start of Monday is that this course is divided into 2 parts. Part 1 is dealing with the more introductory level topics. So we covered the basics on Monday. Today, we're going to talk about the practicalities of trading and combining options together. And then we're going to, in session 3, which is scheduled to run next Wednesday, we're going to talk about an introduction to how we price options and how we think about the risk on an option contract. Options are more complex than stocks, so the risk is also slightly more complex than stocks. That makes them mathematically interesting, but it also makes them quite tricky to understand all of the risk parameters. So we're going to be dealing with that on Wednesday in as gentle and intuitive way as we can. So that's part 1. Part 2 is where we get to do a bit of a deeper dive. So anyone who's interested at that point in learning just a little bit more depth on options, this is where we will take you forward. So session 4, we'll talk more about this thing called volatility. We're going to mention that actually today, how we trade the volatility of the market. So session 4 does a deeper dive on that. Then we go further into option pricing in session 5. And then session 6 is a time for us to have a bit of a question and answer session. I will deal with any of the maybe slightly lengthier questions that people have asked during the preceding 5 sessions. Maybe we'll answer those in session 6. I'll also give you examples of some of my experience trading options over the last 25 years or so, and maybe some things that have gone wrong and maybe some things that you can learn from some of my mistakes. Okay, so what are we going to learn in this session? I like to divide these things into 3 main learning outcomes. So here are the 3 for today's session in front of you. We're going to learn how we combine options together. Options allow you to take a slightly more sophisticated view on the market than you could ever take if you just use cash stocks or futures contracts. If you use cash stocks or futures contracts, essentially the views you can express is the market goes up or the market goes down. That's basically it. With options, we can express the view that the market goes up by a certain amount, or the market goes down within a certain time period, or maybe it doesn't go down within a certain time period. And when we combine options together, we can be even cleverer about exactly what payoff we want to create. So those kinked lines that we saw in session 1, where we either get a 0 payoff or we get a 45-degree line moving 1-for-1 with the underlying stock, if we combine those payoff profiles together, we can generate some quite sophisticated ways of taking risk in financial markets. So we'll talk about what option combinations are. We'll explain why they allow you to take a slightly more sophisticated view. And then we're going to finish by talking about how we trade the volatility of the market. Now, this is not possible using regular stocks. So it's not possible using shares, the regular stock market. With regular stocks, you can only trade direction. With options, you can trade how much the price moves up and down. Are we going to go into a marketplace where the movements up and down might be quite dramatic, or are we going to move into a period of time where the market's going to be relatively calm and prices will stay within a fairly tight range? Using option contracts, we can express a view on what we think the future volatility of the market for this stock will be. Okay, just before we get started on the content of session 2, I did leave you at the end of session 1 with a question to answer. We had a look at a screenshot of Amazon options. Now, these obviously are listed in the US, but it gave us a chance to have a look at a real-life screen showing option prices. And I left you with a question to have a think about regarding the trading of Amazon options. So I thought we'd just start off by debriefing that question. It will give us some of the insights that we're looking for in terms of the practicalities of trading these options. Okay, so the details of the contract are up here at the top. Amazon options, they work exactly the same as the 4 options that are going to be available to you to trade on the Saudi exchange, in that each option has a contract size of 100 shares. So if I buy one call contract, it gives me the right to buy 100 shares. If I buy one put contract, it gives me the right to sell 100 shares. If I scale that up, of course, if I do 10 contracts, then that's going to be equivalent to 1,000 shares, 10 times the size of a 100. Okay, so we're bearish Amazon stock, which means that we think that the price of Amazon shares is going to go down. And we buy 10 contracts of the December 2023. This is the expiry date. So this is the time period over which we're taking this view. 130, this is the strike, denoted by a letter K as we used in session 1. Put option. So this gives us the right to sell. So this is a bearish trade. This is an expression that we think the stock is going to go lower because we get the right to sell it at a fixed price, 130. And if the market goes lower, we can exercise our put option and then buy the stock back in the market at a lower level and lock in a positive payoff for ourselves. And the final piece is that we buy these options at a premium of 605. Okay, so just thinking about the payoff of these options, if I just draw a crude set of axes here, and this is payoff, and this is the Amazon price, then 130 is our strike, and below 130, this put is going to produce a positive payoff. And above 130, we're going to get 0. Of course, we've paid the premium of $6 here, so we're going to lose $6, but we're going to have paid $6 regardless of what our payoff is. But that's the payoff as it looks on expiry. Okay, let's just clean up a bit of space. So few questions you're asked here. Firstly, what's the premium that we've effectively paid? Now, when you trade options on an exchange, of course, you're going to trade on margin. The margin for trading options on the Saudi exchange, if you buy an option, the margin is going to be the full premium. So if you buy an option, you do have to pay the full premium on day one. So the premium that we've paid here, the premium here is 6.05 per share. And we know that each contract is representing 100 shares. So that's going to be $605 of premium for every contract we have. And we have 10 contracts. So our total premium is going to be the option price that we see on the screen per share, multiplied by the contract size of 100, multiplied by the 10 contracts that we bought. So we're going to invest $6,050 of premium in this December 2023 130 strike put on Amazon stock. Okay, what is our break even? So if you remember, the break even is when the payoff of my option is equal and opposite to the premium that I've paid for it. Now, the payoff of my option, if it's a positive number, the payoff of my option is the difference between the strike of 130 and the stock price. And I'll ignore that if it's negative. So I can walk away if this option is trying to create a negative payoff. I can just call it 0. So I'm only going to accept this payoff if it's positive. And therefore, as this stock goes down below 130, this put option will generate a positive payoff. And so I need 130 minus the stock to equal 605 if I am to break even, which means that I need the stock to be trading at 123.95 or lower to make a net profit. Now, just to be absolutely clear, I will exercise this option if the stock finishes anywhere below 130. However, I will only make an outright profit if we finish below 123.95. So that's my break even. The final section imagined that we step forward in time now and we know where Amazon shares have finished on expiry, and the answer to that is they finish at 118. So this is good for me. I've taken a view that Amazon shares are going down, and they have. I get the right to sell them at 130, and then I can simultaneously buy them back in the market at 118. So my total P&L is going to be combined, it's going to be made up of the combination of my payoff from the option on expiry, and then subtracting from that the premium that I paid on day one. So here's the full calculation. So the payoff is the difference between the strike at which I sell and the market price at which I can buy back, multiplied by the contract size of the option, multiplied by the number of contracts which I've bought. So the combination of these two things is my 1,000 shares effective size. So that's going to give me a positive payoff of $12 per share on a 1,000 share position. So that's a positive payoff of $12,000. I paid $6,050 for this option. So my net profit is going to be the difference between those two numbers, which is $5,950. And by the way, you can get the same answer if you do the break even of 123.95 minus the market price multiplied by 1,000. That will also give you the $5,950 of profit. Okay, so that's the answer to that question. That's the full debrief. Hopefully that's made some sense to you. If you did that in your own time, then hopefully you got it right. But if you didn't, hopefully my explanation has shown you where you might have gone slightly astray. Okay, so within this example, we've covered the practicalities of how you might trade. What does the price actually mean in terms of the cash that you would pay? what does the break even actually mean in terms of turning you from making a net loss to making a net profit? And how would you work out your cash profit if you took a long or short position via an option on one of the 4 stocks that will be trading in the single stock option market in Saudi? Okay, so moving on into the main content of session 2 now then, we're just going to recap by remembering the 4 individual option positions that we can take using single stock options. So we can buy or sell a call or a put, which gives us 4 different things we can do: longer call, longer put, shorter call, or shorter put. And we had a look at this slide on Monday in session 1. The reason to recap this is we're going to combine some of these positions together for our combinations today. And the reason that we're going to combine options together is because sometimes when I look at trading a single option, the premium doesn't suit my trading idea, as in it might be too high for me to bring myself to pay that upfront in order to take my view. If the premium is too high, and remember the premium is the price of an option, and we can never really talk about trading anything without discussing the price. If I want to buy an option, of course, my appetite to buy that option has to be a function of the premium that I want to pay for it. I can't just pay an infinite premium. There's going to be a finite cap to how much I'm willing to pay. And the problem, if you look on the graph on the left-hand side here, is that if I've got a 100 call, so these are all for 100 calls, then the higher the premium, firstly, the bigger my maximum loss in the event that this option finishes out of the money. But secondly, the higher the break even, because of course the stock has now got to go up further to make me back a bigger premium than it had before when the premium was lower. So what higher premiums really mean in terms of a directional view is that you now need to think that the stock goes further than it did before in order for you to break even on your trade and move into an outright profit scenario. One thing that people might do, and we'll discuss this effect a little bit more in session 3 next Wednesday, but what people might do is they might say, well, let's change the strike of the option. If I can't afford a 100 call, if the 100 call is too much, then why don't I buy a 110 call instead? A 110 call is not worth as much as a 100 call. And the intuition there is if I've got something that gives me the right to buy at 110, that's not as good as another option which gives me the right to buy at 100. That 100 strike option gives me the right to buy the stock $10 cheaper than the 110 strike call. So the 110 call is going to be cheaper. So you can see here, as I raise the strike, my premium does indeed get less, but the problem is because the strike has gone up, my break-evens still move higher. So when we're in a world where premiums are high, we can't really get away from the fact that our break-evens are going to be higher if we buy calls or lower if we buy puts. Now, of course, for certain investors and traders, when the price of something gets too high for me to want to buy it, that's when I want to sell it. So the high premium world, if you did encounter options with premiums that you think are too high, the obvious thing that you could do is start selling options instead. But there is a section of the option trading world which likes the reassurance of only buying options because I have that limited downside of knowing that I can't lose more than the premium that I've paid. In which case, if options start to get too expensive, I just have to find another trade to do which doesn't involve options. Or I can combine 2 or more options together in a premium reduction strategy whilst still maintaining my core view. So that's what we're going to look at now. So this is their solution down at the bottom. If options look too expensive, why don't we sell some options as part of a combination? Okay, so we're going to look at a series of combinations of options, 4 main types, and I've got them all up on the screen here. We're going to look at what we call spreads. We're going to look at risk reversals, a slightly odd name, but I'll try to explain why they're called what they're called. We're going to look at covered calls. This is quite a popular strategy for those people who find themselves naturally long stocks and want to express a view using options. And then finally, we're going to have a look at some slightly oddly named combinations called straddles and strangles. And it's the straddles and strangles which allow us to trade the volatility of the market instead of just taking a view on the direction of the stock. So these first three allow us to trade the direction of the stock. And then the last block, the straddles and strangles, allow us to express a view on the volatility of the market. Okay, I'm going to move just to one of my spreadsheets now. So I'm just going to change the screen that I'm sharing. Let's see if I can maximize that, fill the screen. Okay, so what we've got here is I've got an option pricer. I'm not going to go through exactly how the price is calculated here. Let's just assume this is a correct price. We'll view it as just a mathematical black box for now. But in session 3 and then also in session 5, we'll dig a bit deeper into how options are priced. So for now, my spreadsheet's just going to give me a price that's correct for a given option. If you have a look at the details up here, I'm going to price options with a contract size of 100, which is exactly what we're dealing with on the Saudi exchange. I've got an expiry of half a year, and we're looking at a stock which is trading at 100. Now, I've labeled it future, but really we're just talking about the underlying stock level here. If we go across to this blue section, this allows me to price up 4 different options, and I can choose whether I want a call or a put. I can tell it how many contracts I want. I can specify a strike. It's going to give me a price. It's also going to give me a cost in Rial to trade this option. And then down below, I've got a payoff profile. So when I combine up to 4 different types of options, I will see the net payoff displayed down below. Okay, so this is a straightforward long 100 call that we're looking at here. So a strike of 100, I've bought 1 contract. It's cost me 563.72 Rial, and my payoff is as per the graph. And you can see that I have an obvious, let me just see if I can change the color of my pen. I have an obvious break even here of around 105.6 Rial in terms of the stock price. Now, if I look at that and think that this option looks too expensive, what I'm really thinking is that break even is too high. I don't really think the stock has much of a chance of moving too far beyond that. So all of these payoff possibilities, all this profit opportunity up here in this shaded area, maybe I'm assigning a relatively low probability of finishing far into that section. So if I've got a view where I do think the stock goes up, but maybe I don't think it goes up by too much, then I'm going to look at this option and think it looks a bit too expensive. What I could do now is, given that I think options are expensive, why don't I look to sell another option to somebody else so they will pay me some premium, and I can offset that against the 564 Rial that I need to pay for this option. So what we do is we trade a second option here. So I'm going to add another option, and I'm going to create what we call a call spread. So I'm going to choose a different strike. I'm going to choose a 110 strike. Now what we can see, if I just zoom in on the prices, is the price for the 110 strike is lower than the price for the 100 strike, which is what we expect. We're also going to sell this second option. So I'm going to go and put a -1 in the position there. And what we now see down below in the net payoff is the combination of these two things. My overall premium has reduced from 564 Rial down to 343. So it's reduced by 220. So that's not far, that's probably about a 40% reduction in the overall premium that I've paid. I'm still long a 100 call. That's what this first option is. But what I've done is I've sold another call option against it, which will act to cancel out the effect of that 100 call once we get above the higher strike. When we get into this region here, both options will be exercised, and I will be buying the stock at 100, but then simultaneously selling it at 110 as that second call option is exercised against me. So I have capped my maximum payoff now at 10 Rial per share. This has given me a reduced premium structure. So instead of paying 500 and something Rial, I'm paying 300 and something. But what I've done as a trade-off is I've capped my maximum possible upside. So now when I make a profit, I can make no more than 10 Rial per share, regardless of how high the stock finishes. So this is a very common strategy for those who want to take a bullish view on the stock, but can't quite bring themselves to pay the full premium of an at-the-money call option. Instead, you can buy an at-the-money call option and sell a high-strike call option, and lock in this position that we call a call spread. So I'm just going to move us back to the slides because I have a nice, neat picture of this on the slides. And then I've got a question for you. And while we think about the question for you, I'll have a look at the question that's come up in the chat and see if I can answer that as well. Okay, so on this slide, we see that we are combining a long 100 call, which is the blue dashed line there, with a short 110 call. And the green line that we can see is the combined payoff. If we finish below 100, then I lose the net premium that I've paid. But remember, that net premium is now lower than if I just bought the single 100 call. If we finish above 110, then my payoff is capped at $10 per share. And of course, my profit, therefore, is capped at $10 per share minus the premium that I've paid. And interestingly, between 100 and 110, I'm actually really just long a 100 call because that's the only option that's going to be exercised. I'm going to exercise my 100 call, and the 110 call is not going to be exercised against me because that's going to finish out of the money. So the question's on the right-hand side here. What is the trader's view? The trader's view is that the stock goes up, but by a limited amount. And therefore, they don't want to pay the full price of a call, which seems to give me unlimited upside when I don't think that that's possible. I want to pay a reduced premium and accept a limited view. The trade-off that I'm making is I'm reducing my premium. That's the difference over there on the left-hand side between the net premium of the call spread and the full premium of the 100 call. And what I'm essentially trading off is a reduction in that amount versus giving up this right to benefit that I would have if I just bought a single call option and the stock went significantly higher. Okay, so I'm going to pause for a second while you have a think about a question. That question's in front of you on the screen. Which of the following is an advantage of trading a call spread instead of just a call? So you have a look through those 4 alternatives that are in front of you on the screen. I'm going to give you 30 seconds to have a think. Just as in session 1, there's no need to answer on the chat, although of course you can if you want to. There's no need to answer out loud. Just have an answer in your head. I'll come back to you in about 30 seconds time, and you can tell me what you can mark your own homework and see if you got this right or wrong. So I'll just go quiet for 30 seconds and then we'll talk about the answer. Okay, let's go through these in turn. Let's think about answer A. The upside potential. Is the upside potential increased? Well, one way of thinking about that is going back to this original diagram, and actually no, it's the opposite. The upside is limited. That's the whole point of the trade, really, to limit my upside in order to reduce my net cost. So no, I'm limiting my upside compared to buying a regular call. That's that shaded area there. So A is not correct. The net premium is reduced. Yes, it is. And actually, this is the only correct answer. So B is the correct answer to this. When people trade call spreads from a long position, as in they're buying, in this case, the low strike call and selling the high strike call, they're in it for the reduction in premium. That's the reason why they're doing it. C, you make money if the stock goes down. Well, let's just revisit this this line over here. You don't make money if the stock goes down. If we consider that we start at 100 and the stock goes down, well, actually both options will finish out of the money. I've bought the more expensive of the two options, so I've paid an amount of premium, so I'm just going to lose that net premium. It's going to be smaller than it was if I had the outright call option, but I'm still going to lose my premium if the stock goes down. You are guaranteed to make a profit if the stock goes up. Well, no, that's not quite correct. And the reason that's not correct is you still have a break even. So let's just clear this diagram up a little bit. You still have a break even. If the stock starts at 100, like all of the examples that we're going to talk about in this course, if the stock starts at 100, it has to still go up by a certain amount to cover that positive premium I've had to pay away. Now, the break even is lower than if I bought the outright single 100 call, but it's still above 100. So there are instances, and you can probably see just by eyeballing this graph, if the stock only finished at 101, I'm going to exercise my 100 call, but the payoff is not going to be sufficient to cover the premium that I paid. So the correct answer to this is B. Well done for those of you who said B. Okay, let me move us back to my spreadsheet for a second, because I just want to consider what could we do as an extension of this. Now, traders in the market have varying degrees of risk appetite. Some traders are quite risk averse. Some traders are quite risk seeking. And a risk seeking trader may look to trade a slightly more aggressive version of a call spread. And there is a more aggressive version of a call spread that we call a ratio call spread. And the ratio call spread has you trade more of this top call than you've traded of the bottom call. So we're going to do a bigger size now of the 110 call compared to the 100 call. So this is how it would work. Instead of selling one contract of the 110 call for every contract I bought of the 100 call, why don't I sell two? Now, part of the logic here is, well, if I'm happy to sell that 110 call, I'm happy to sell it. You know, why don't we sell more? If I think the price that someone's paying me is attractive, why not sell more? Really, though, once I press return here, you'll see the net payoff, and then hopefully the motivation of someone who does a ratio call spread will become apparent. So that's the payoff of the ratio call spread. Now, there's a couple of things to notice here. Firstly, let's zoom in on our premium. 564 real is the premium of buying the 100 call outright as a single trade. Now, to take this new position, I've reduced that to something that looks around about 20% of the full 100 call price. So I'm only paying 121 real instead of 564. So that's good. This is a slightly enhanced premium reduction technique. And then the second thing to notice is, rather than with the call spread that we looked at before, I flatlined my maximum profit up here, because at this situation, I was buying at 100 and then simultaneously selling at 110. Well, now with the ratio call spread, I'm doing the same thing, but this sale is in 2 times the amount. So the first unit of the 110 call cancels out the 100 call, and then the second unit of the 100 call takes me net short a call option with a strike of 110, and that's why we see this line starting to track down diagonally 1-for-1 with the stock. So what I've got here is a position where I'm taking a bullish view on the stock, but if we finish here, which is somewhere just below 120, I'm going to lose money in outright terms. I'm going to make a net loss. So now you can see the trade-off here. What I'm doing is I'm saying, I think that we will finish in that triangle in the center. I think we'll finish somewhere here. I have a break even on the low side above which the stock needs to finish to make me money. And then I have another break even on the high side above which I'll flip from making a net profit to a net loss again. One win, though, is if the stock goes down and my original bullish view on the market proves to be incorrect, the amount of premium I reduce has been heavily, the amount of premium I lose has been heavily reduced compared to just buying a 100 call. Okay, so this is the ratio call spread. And if I just go back to the slides, you'll see that we have a nice, neat diagram on this. Oops. There we go. So the combination of 1 times a low strike call minus 2 times a higher strike call would take us into a 2-to-1 ratio call spread. And you might not be surprised that some of the more risk-seeking traders in the options world don't stop at a 2 times ratio. They can trade a 3 times ratio, 5 times, 10 times. You can tailor this to your own personal risk appetite. So a more aggressive trade, but the reward is a further reduced premium. Okay, I'm just going to go back one slide because I just jumped through another question for you. Have a look at this question that's on your screen. We're going to use some real numbers now to price up a deal. So you think a stock goes up, but by a limited amount. You decide to express your view using 10 contracts of the 100-110 call spread. Now that means you're going to buy 10 of the 100 strike and then sell 10 of the 110 strike. So you're going to do 10 contracts of each. You're given some market data here. The stock's trading at 100. The 100 call is trading at 5.5. That's its premium. And the 110 call is trading at 2.2. So I want you to tell me 3 things. What's the net premium to buy 10 contracts of each? What's your maximum profit? And then what's the break even? Where do you need the stock to finish above in order to make a net profit on this? So I'm going to give you about, I think, about a minute to have a think about this because there's a few moving parts here. So I'll just go quiet for a minute and then we'll debrief this at the end of that minute. Okay, let's go through the answer to this. I'm going to do it in Excel. So we've got a 100 call trading at 5.5. We've got a 110 call trading at 2.2. These numbers, if you remember, these are all per share. So you can always look at these numbers per share. That gives you a really easy way of comparing it to the strike price, because of course the strike price is a price per share. That's how shares are quoted. So the net premium that I would receive or pay if I trade this call spread is going to be equal to the premium that I pay to buy the 100 call. So I'm going to represent this as a negative number here. So I'm going to pay out 5.5 real per share. And then I'm going to receive 2.2 when I sell the high strike call. So I'm net paying 3.3 real per share. And then I have to remember that the contract size is 100 shares. So the net premium per contract is going to be 3.3 multiplied by 100, so 330 real per contract. And I have 10 contracts, so the net premium on my trade, in fact, let's just drag this down and put in the number of contracts I own. The net premium I pay is going to be 3,300 real. Okay, so that's the answer to part one. How much do you pay? Your maximum profit. Okay, max profit. The maximum profit is going to come when both options are exercised. When both options are exercised. So I need to work out what's going to be the payoff as both options are exercised. And this is going to occur at 110. My maximum payoff is actually when I'm exercising my 100 call and the 110 call is just about to be exercised, because I know as soon as that happens, I'm just flatlined from that point on. So my maximum profit is going to be equal to the difference between the strikes. So let's just put the two strikes up here. So let's have strike one, strike two. Maximum profit is going to be the difference between these two strikes multiplied by the contract size. That's going to give me the payoff, the maximum payoff per contract. And then I'm going to multiply that by the number of contracts. Now, that's not actually my maximum profit, that's my maximum payoff. So the maximum payoff I'm going to get is 10 real per share on a 1,000 share position, which of course is 10,000. My maximum profit, therefore, is equal to this payoff minus, or plus, because my premium's already represented as a negative number, the premium of 3,300 that I've paid, and therefore my max profit there is 6,700. Good, I can see some right answers on the chat, so some of you are getting this. That's excellent. Okay, the next thing to understand is my break even. And my break even is going to be, where does the stock need to finish for my payoff to equal 3.3? Because that's the net premium per share that I'm paying. Now, I know that when both options are being exercised, my payoff is 10 real per share. So actually this break even will be down below the strike of the second option. It'll be just above 100. And so when I start to exercise my 100 call, my 100 call needs to generate a payoff of 3.3. And that's going to happen when the strike plus my 3.3 per share. I've got my 3.3 as a negative number here, so I'm going to subtract that. So when the stock is at 103.3, I know that the payoff of my 100 call is going to be equal and opposite to the premium that I've paid for it. So there's my break even there. So net premium on the trade, 3,300 real. Maximum profit you can hope to make, 6,700. Break even at 103.3. So this is the stock price you think we will finish above. And that's the important thing. If your view isn't that we finish above 103.3, this is not the right trade for you. So your view has to be aligned with a finish of at least 103.3. Great. Let's move back to slides. Nice to see people participating in these exercises. It's your chance to try to put some of this, this information to use. Okay. Question now, again, to have a think about these ratio call spreads. Just let me remind you what the payoff profile looks like for a ratio call spread. If you remember this slightly more aggressive trade, we're assuming that the stock's going to finish not anywhere above a certain level, but in that triangle between those two break-evens. So I want you to tell me which of the following four statements is correct. So this is true when you're buying ratio call spreads compared to regular call spreads. So I'll give you 30 seconds to have a read through all of those, and then we'll talk about the right answer. And there is one of these, which is a right answer, but it could be the one that says that they're all right answers. So I'll let you have a think about this, and then in 30 seconds time, we'll go through the answer. Okay, we've had some answers on the chat and they are all correct. Ooh, except one that I've just seen come through. If you answered D, you're correct. So let's just go through them in turn. The net premium is further reduced. Yes, it is. That's actually the whole point of doing the ratio. If I sell 2 times, then I'm going to receive 2 times the premium on that high strike call option instead of just 1 times if I use the regular unratioed or ungeared call spread. So the premium is further reduced. That's correct. You now have 2 break-even points. Yes, you do. You've got a low break-even above which you must finish. And then you've got a high break-even below which you're hoping to finish. So you don't want to finish above your second break-even. So yep, that's correct. You are now exposed to an unlimited loss. Yes, you are. Yes, you are, because you're net short a call option once you add everything together. And here's your unlimited loss starting to grow down here. And if I extended that x-axis to a higher and higher stock levels, that green line is just going to inexorably carry on downhill to a bigger and bigger loss. So all of the above is the correct answer. Okay, risk reversals. Risk reversals are a slightly different way of expressing a directional view on the stock. Now, I should just pause at this point and say, all of my examples are talking about a bullish position. You think the stock price is going to go up, but that's only just to keep them all consistent and straightforward and simple to understand. We could equally make exactly the same, express exactly the same view the other way, so that we think the stock's going down. We could buy a put option instead of a call option. We can buy a put spread instead of a call spread. We can buy a ratio put spread instead of a ratio call spread, and so on. And so this is another long directional position, but if I just flip the sign of my position here, then I'm making a bet the stock goes down instead of the stock going up. Okay, so risk reversal is an odd name, and I think this will become a little bit, we'll get a little bit of intelligence on this in the next session as to why a trader might refer to this as a risk reversal. But it might not be until session 5, maybe, that it's fully apparent to us why this is called a risk reversal. So for now, we're just going to accept the name, and I'm going to describe what it does. Okay, so what you can see here is the green line is our net position. So the first thing to notice is it seems to give us a call option-like payoff, in that that green line is going up at 45 degrees and would seemingly carry on for as far as I want to scale that x-axis up. The blue line here, this is a call option. This is the 100 call. So you can see when the stock goes up, my green line mimics the direction that the 100 call payoff goes in. Not only that, it outperforms it. And the reason that it outperforms it is that the net premium on this combination is almost zero. In fact, we'll just say it's approximately zero. Now, the way that I've done this, the way that I've bought a call option and paid nothing for it, is I haven't sold another call option and capped my maximum payoff. Instead, I've sold a put option. So this purple line here is a short put. Now, sorry, I just need to correct something on here. This is not a 100 call anymore. I've done a 110 call to express my bullish position. And the put that I've sold is I've gone short a 90 put. So 100 is sitting there in the middle. That's where the stock's currently trading. If we go up above 110, I'm going to make a profit. But if we go down below 90, that 90 strike put is going to be exercised against me, and I'm going to make a loss. The reward for taking this position is that premium, which is almost zero. But what I've done is I have opened myself up to the possibility of large losses if the stock goes down, because I've outright sold a put as part of this combination. And I'm trading that off against the possibility of big upside gains if the stock goes up. So people who trade risk reversals, I guess you could say this is a slightly more aggressive view than a standard call spread, because I'm not willing to limit my upside payoff. I'm wanting to reduce my premium, and I do that by accepting the possibility of a large loss if the stock goes down. So if my view is not correct, I'm potentially making a large loss here, whereas if I bought the call spread, all I'm losing is the net premium that I've paid. So it's possibly slightly more aggressive view, but that might suit the risk appetite of some people in the options market. And certainly there are many traders in the options market that will trade risk reversals to express a directional view. Just to pick up on a couple of these questions that have been coming in, somebody's asked, what's the ratio spread? Let me just go back to the slide on the ratio call spread. This is the ratio spread, where I trade one call against another. So I buy one and I sell the other, but I don't do them in equal sizes. I do them, in this case, in a 2-to-1 ratio. So I've bought 1 unit of the 100 call and I've sold 2 units of the 110 call at the top. So that's what we mean by a ratio spread. There was a question up above that said, please can you explain what is payoff? The payoff of an option is the difference, it's the difference between the stock minus the strike if it's positive. So if I've got a call option and the stock finishes above the strike, then I can exercise it, buy at the strike and sell at the market and generate a positive payoff. So payoff just means money coming to me. By the way, I wanted to limit the mathematical representation in this course because it is targeted at people at an introductory level of options knowledge. But we do sometimes say that the payoff of a call is equal to the maximum of the stock at expiry minus the strike, or 0. And that's how you would write it mathematically. And actually, that's how you could use it in Excel if you use Excel's max function. So there's difference between the stock and the strike, but only if it's greater than 0. So if that difference number is negative, then that max term returns 0 instead. And the payoff of a call, sorry, a put, is just the same, but with the stock and strike flipped around. So the strike minus the stock on expiry, or 0. So for those of you who understand that kind of max notation, that might help you understand that. I'm just going to scroll a little bit further up on the chat because we had a question at the start. Somebody said, does the price of the option depend on the current price of the stock at the time of buying the option relative to the strike price? Yes, it does. That's one of the main drivers of the value of this option. So yes, it absolutely does. It really matters where the stock's currently trading and then where I set that strike. And that, if you don't mind, that's the subject of session 3. So I'm not going to say any more on that because in session 3, we'll be talking about the key price drivers of options. And that's certainly one of them, the difference between the stock and the strike. Good. Thank you for those questions. Okay. So risk reversals, another way of taking a directional view. Covered calls. Now, I've used the words yield enhancement here because covered calls suit somebody who's already long the stock. If somebody's already long the stock, they might be long the stock because they like to receive the dividends. They think the stock pays an attractive dividend yield. They're in it for this yield. And what the covered call allows them to do is enhance the yield on their portfolio in certain circumstances. So what it means is this is my long stock position, this purple line here. And against my long stock position, I am going to sell a call. Now, I've looked at selling a call which is at the money here, a 100 strike call, but equally you could sell an out of the money call with a higher strike if you want to. The purpose of this, actually, firstly, before we deal with the purpose, let's deal with the name. The reason they're called covered calls, covered in finance means essentially I already own the thing that I might have to deliver. So I already own the stock. So if this call option is exercised against me, because remember, I'm selling this call option to somebody else, if they exercise it against me and I have to deliver them the stock at 100, then I actually already own the stock. So I can just deliver them the stock that I've already owned. We say that the exercise is covered by my underlying stock position. Now, if I sell a call option, of course, someone's going to pay me a premium. So you can see that if nothing happens, if we just stay around 100, then my long stock position makes 0 because the stock's not moved up or down. And I just walk away with the premium on my call option. In fact, if the stock finishes anywhere below the current market level of 100, then I will just collect the premium on my call option because it will finish out of the money. Of course, I'm long the stock, so if the stock's gone down, I'm losing money, but I'm losing slightly less than I would have if I didn't sell the call option because I've got that premium to just cushion the blow. So that's how you can see when the stock's falling, this strategy will outperform what would have happened if I'd done nothing, if I'd just owned the stock and done nothing else. The dangerous situation for the seller of the covered call is if we finish up here in this shaded triangle area here, because of course, once we start to move up above the break even of this call option, I'm going to net lose money on that call option. And that is then subtracted from any profits that I'm making on my long stock underlying position. So if the stock moves up, in this case, 50%, and I would have been at plus 50 had I not sold the call, instead, I've just collected my premium. And maybe my premium was 3% of the share price, so I'm only up 3% instead of plus 50. So I'm probably at that point kicking myself in hindsight that I sold this call. So really, if you look at the ideal scenario here, the ideal scenario really is we finish right around where we started. We finish right around 100, and all we do is we walk away with the premium, and we also don't lose money on our underlying stock position. So your turn again. Thinking about a covered call, in what scenario would someone who is long a stock consider selling a covered call? Which of the following scenarios, A, B, C, or D, do you think is the correct answer for why the motivation as to why somebody might sell a covered call? So again, I'll give you 30 seconds to have a think about this, and then we'll go through the answer. Okay, we've got some answers coming through. There's certainly some correct answers in here. So let's go through and let's deal with them one by one. Would they sell a covered call if they expect the stock to go up? Well, no, they wouldn't. This strategy entails you going short a call option. Now, if you think the stock goes up, you don't want to be selling a call option. That's going to profit whoever buys it from you. So if you think the stock goes up, do nothing else. Just carry on owning the stock. So no, that's not why you would do a covered call strategy. B, they expect option prices to increase. Well, that's not correct either, because you're selling an option here. Why would you sell something whose price you think is going to go up? What you could do is wait and sell it later if you think the option price is going to go up, but you certainly won't want to take a short position in a product whose price you think is going to rise. So that's not the reason that somebody would go into this trade. C, they expect a period of market stability. This is our correct answer. So yes, they expect a period of market stability, because if we get a stable market where the share price remains roughly constant, then all they're going to do is collect that premium. Various investors, by the way, they model up a covered call strategy so that you can back test it through time, and you can say, look, if I'm a traditional long stock investor, in that I generally buy shares, I may choose which ones to buy, but I'm generally a buyer. What would happen if I sell a call option with, let's say, a 3-month expiry, and every time we get to the end of 3 months, I sell another 3-month call option, and I always choose a strike that's maybe right around where the market's trading at the time, and people will back test that methodology to see when it performs well and when it performs badly. And it might not be a surprise to find that when the market is relatively calm, the rolling covered call strategy performs quite well. But when the market is very volatile, it performs poorly. Okay, answer D is not correct. They want to be protected from a fall in stock prices. Well, if we go back to the diagram, they're not actually protected from stock prices going down. They still lose money as stock prices go down. However, for those of you who did say D, I think I know what you're thinking about here. The blow is cushioned slightly because they get to walk away with this premium. So let's say the premium is 3% of the stock price. That means that if the stock goes down 20%, you're only down 17 because your underlying is down 20, but you've made 3% of premium. If the stock's down 10%, you're only down 7. If the stock's down 5, you're down 2, and so on. So you have a certain enhancement to your position, but you can't prevent it going more and more negative. Okay, so that's the combinations of options that one could use to express a directional view on the market. In the last 10 minutes or so, we're going to move on to the last point on my three-pronged learning outcomes slide, which is understanding how we might trade the volatility of the market. So all the combinations so far, we've taken the view that the stock will either move up or down. What if we want to take the view that the stock's price will just be extremely volatile, will move up or down in a big manner? And we can only do this, as I said at the start of this session, we can only do this by trading options. So we're going to trade these combinations called straddles and strangles, and I'm just going to briefly talk through them, and then we'll bring the session to a conclusion, and I'm going to leave you with a question to think about that's going to look at a combination of these and a volatility trading position. Okay, so to discuss straddles and strangles, I just want to take us back to our spreadsheet. So here's the ratio call spread that we were looking at before. So let's just get rid of this. So I'm just going to take that back to 0. So this is the long call. Long call, I pay premium. I make essentially I'm taking the view that the stock goes up. Okay, so that's one option that I can do. I can also add to that a long put position. So what if, let's change this toggle here to put on option 2, and I'm going to trade 1 unit of the put option and 1 unit of the call option. Now, the first thing to notice is I'm paying double the premium. I'm buying 2 options now instead of 1. So my premium is now becoming relatively expensive. But the secret to why I might want to do this deal can be seen in the graph. Now, I'm not taking a directional view because actually I make money if the stock goes down or up. What I want is I just need it to move. So essentially what I'm saying to the stock is I don't care which direction you move in, just move. And my worst case scenario is nothing happens and we finish in this central triangle here. So my maximum loss down at this bottom point here is double the premium of the call option and the put option because I'm adding the 2 together. Okay, so if people want to take a view that the market will be volatile without a view on it going either up or down, then straddles is what we trade. And equally, if this is a view that the market will be volatile, if I reverse it and sell both options, then I can take a short straddle position and take the view that the market will be calm. If I take the view that the market will stay relatively range bound, then I make money if we finish in that central triangle. And obviously I can incur some the possibility of some large losses if we do get a highly volatile scenario. So if I think the market will be high volatility, and by the way, in options, we always shorten volatility to vol, V-O-L. High vol, I want to be long the straddle. And if I think the vol is going to be low, I want to go short the straddle. And so in the wholesale market, straddles is what traders trade with each other to express a view on the volatility of the market. Now, there's an alternative to a straddle, and it's called a strangle. And we'll go back and see these on the slides in a second. But if I just change this back to the long straddle position, if I trade a strangle, what I do is I just adjust these strikes slightly. Instead of making them both at the money, which is what I've got here, the market's trading at 100, and I've fixed both of these strikes at 100. Why don't I buy a slightly high strike call, so a 110 call, and a slightly low strike put? The advantage to this is it reduces my premium. If you remember before, well, let's go back and return it to the original 100. Before, my premium, the total, is 1,127 real per contract. Well, now, if I raise the strike of the call and lower the strike of the put, my premium drops to something around under 40% of what the straddle costs. So this is now the long strangle position. And again, the motivation becomes apparent when you see the payoff. So now, instead of tending down to a big negative triangle down here where I can lose money, my downside is now limited at the now much lower premium that I've paid for the net combination. But I now need the stock to move further than it did before. So my break-evens on the strangle will be wider than they are on the straddle. So another way of trading the volatility of a market may be a slightly dampened down version of the straddle here. So we stretch the strikes apart, make them both out of the money, pay less premium, but trade that off against lower possible upside because the stock has to now move further for either option to finish in the money. So if I just pop back to the slides again. There's our long straddle. So I've got the purple and blue lines are the two individual call and put options, and then the green line is the combination of the two, exactly as we saw on my spreadsheet. What I've said here is that we usually choose the at the money strike for our straddles, or on exchange traded options, we'll choose the strike which is the closest to the at the money. So you're going to get a series of fixed strikes to trade. The one that's closest to the at the money is the one that we'd normally choose if we're trading a straddle. And here's the strangle, again, where we just take the straddle strikes and we just pull them apart so that both options are now out of the money. Reduction of premium widens the break even, so it makes the pay. We need the stock to move further now to generate the same payoff. Final question for us to think about in this session, and then I'm going to put up on the screen the question that I want you to take away and have a think about in your own time. So you think the price of the stock will be range bound for the next 3 months. By range bound, we mean it will stay within a certain range. So let's say in this case, we think it's going to stay between 95 and 105. You decide to express this view with 25 contracts of a 3-month 95-105 strangle. So you're going to sell the 95 put and you're going to sell the 105 call. Here's some market data where I've given you the price of each one. And here are 4 questions to answer. And just to be very nice to you, I've already answered question 1. So we are selling the strangle here. We're selling both of these options. So I want you to tell me, what's your net premium? What's your maximum profit? And what are your break-evens? So I'll give you a minute to have a think about this, and then we'll bring the session to a close, and we'll have about 15 minutes left for any questions that people might have. So I'll let you have a think about this. I'll come back to you in a minute and we'll go through the answer. Okay, let's run through the answers to this. So we're going to be selling the strangle here. We want to be in the position where we're selling both options. We think they're actually both going to expire worthless. So we're very interested in selling them to anyone who'll pay us a non-zero premium because actually we think they're worthless. People will pay us a non-zero premium. There's a market price of 2 for the 105 call. There's a market price of 1.9 for the 95 call. And we're going to size that up by trading 25 contracts of each. So let's just move across to Excel to put the numbers in. So this time, unlike with the call spread where we were buying one and selling another, we're going to be selling both. So actually the net premium of this is going to be the two premiums added together. So we're going to net 4.1 real per share. We're going to do it in a contract size of 100, and we're going to trade. So let's put trade size rather than number of contracts. We're going to trade 25 contracts. Okay, so our premium is going to be equal to that 4.1 per share multiplied by the contract size of 100 multiplied by 25 contracts. We're taking a position which is equivalent to 2,500 shares in the underlying market. So our net premium here is going to be 10,250 real, and we are going to receive this. Okay, next question. What's the maximum profit? The maximum profit is 10,250 real. The time when we do the best is when both options finish out of the money, and if this is the zero line here, both options finish out of the money and we just walk away with the premium. So if we just collect the premium and we don't need to trade any stock with anyone because the options have not been exercised, we're just going to collect all of that 10,250. Okay, so that's our maximum profit. Break-evens. Well, the break-even is going to hit us in two different directions here. There's a high strike break-even and a low strike break-even. So we've got the two strikes over here. Let me just drag those up a little bit. I'm going to break even. So I break even if A, we finish above, let's say, X, when the 105 call is exercised, or B, we finish below Y when the 95 put is exercised. So I just need to work out what X and Y are now. So let's work out what our two break-evens are. Now remember, this is when the stock finishes above the top strike or below the bottom strike by the same amount as the premium per share that I am earning. Now it can only finish in one of the two directions. So it can only finish down below the put strike or above the call strike. So I've got a net premium, which is the combination of the two, and that's what I need to lose before I break even and enter into a loss-making scenario. So break even one, X here, when the stock moves up, is going to be the strike of this call 105 plus 4.1 per share. So when the stock finishes above 109.1, then I will be making an outright loss on this trade. And similarly, if I take the low strike on the put and then subtract from that 4.1, because of course I've got that put has to finish in the money by 4.1 real before the payoff that I'm making to somebody else is equal and opposite to the net premium I've received. So 90.9 is the downside break even there. So if we were to summarize all of this, this trader's view is that over the time to expiry, the stock will stay in a 90.9 to 109.1 range. And therefore, if you think that, this is the trade for you. If you think the stock goes outside that range, finishes outside of that range, you want to reverse this position and go long the strangle instead of short. Good, that's pretty much brought us to a close. Let me just show you the question that I want to set you for next time. So for those of you who received this material, if you've registered for this course, you'll find this in slide 21. For those of you who are just watching online, now's the time you might want to take a picture of the screen. What I'm asking you to do here is to think about how we might combine a straddle and a strangle together and see if you can come up with a combined position. This is going to have 4 different options. 2 calls, 2 puts. The straddle is a call and a put. The strangle is also a call and a put. And I've given you some prices over here on the right-hand side. So I want you to use the prices for the right strikes. I also want you to try to use the correct side of the bid-ask spread. So I want you to use the bid price when you think it's appropriate and the ask price when you think it's appropriate. And then answer the 4 questions that are down there in purple. Okay. This is what's coming up in the next session. So for those of you who come across along to session 3, which is next Wednesday, we're going to talk about pricing. So a nice gentle introduction to option pricing. What drives the option price? What are the moving parts? How do we measure risk? And then how do we use those risk measurements to understand the profit and loss that we make on an option position and potentially to hedge ourselves to reduce our risk? As before, if you want to get in touch, this is the email address you need to contact. Please contact this if you've got any questions about this webinar series, any questions about the product itself, or any questions that you want to put to us to maybe get answered in session 4. Other than that, thank you for listening. And we've got about 10 minutes left where we'll now take any questions. So if you want to put a question on the Zoom chat, now's the time. I think I've answered all of the questions that have come up so far, but I'll just go back now just to make sure that that's correct. So yeah, thank you for listening. Again, hope you've learned something from today's session. You'll probably find as we go through all 6 sessions, they'll become increasingly complex, the subjects that we're talking about, but we'll try and take everything nice and steady so that nobody gets left behind. Okay, so there are a couple of questions coming through about the recording of the session. So yes, I believe the session is being recorded. So that's obviously being recorded in Zoom, but I have noticed that if I go onto the YouTube channel of Tadawul, I can find the session 1 recording up there. So I'm sure the session 2 recording will appear there in due course. Good, so I'll just wait a few minutes and see if we get any questions come through. Of course, if we don't get any questions come through, everyone's free to depart. And if you are coming to session 3, then we'll see you on Wednesday. Okay, so it seems to me that people are reasonably satisfied, or if they had questions, they've taken the opportunity to ask them as the session's gone on. Thank you again for participating. It's nice to see those answers coming through on the chat when we stop to ask you a question. So please continue with your participation there. If you do think of a question that you wish you had asked, or maybe a question that you actually didn't want to ask in public, then please feel free to use that email address to ask any of those questions. But other than that, if there are no remaining questions, I would say good night, enjoy the rest of your evening, and Wednesday the 29th is the next session, and it's going to be 6 p.m. Saudi time again. So thanks for coming, and we'll see you all again soon.